Hello viewers, welcome to my channel. I am Hsham. Last two videos I have explained about capital budgeting. That is very important chapter for financial management subject for BBA students. Now, in this video I am going to start the problems on capital budgeting. Remember, you can understand the problem very clearly if you have gone through the theory videos well. Because without having conceptual clarity, you cannot be able to understand the problems. So my suggestion, be perfect about the techniques of capital budgeting. The different techniques I have explained, like payback period method, accounting rate of return method, NPV, net present value, profitability index, and internal rate of return. All these techniques I have explained how to apply the technique, how to take the decision, and what the advantages and disadvantages of those techniques I have already explained. So if you have not watched, I suggest you go to the playlist of my channel, select the subject financial management for BBA, watch the video of capital budgeting, be perfect about the concept, then you can go for the problems. Now, before starting the problem, I expect my viewers to have a printout of the problems which I have given in the link under my description. Always take a printout and keep it ready. Take the screenshot of the points which I have written on the board, then I'll explain every point in detail. Come on, we'll start the problem. First problem. Calculate the payback period of the project which require cash outlay of rupees 2,50,000 and earns rupees 40,000 per annum for 6 years. Suggest whether the project will be acceptable if the standard payback period is 4 years. That means the management of the company has made a standard payback period of 4 years. The management says accept any project whose payback period is up to 4 years. 4 years or less. If a project's actual PBP happens to be more than 4 years, reject the project. That is the contention of the management. Now we'll calculate what is the actual PBP for this project. Now how much is the cash outlay? 2,50,000. And every year it earns 40,000 rupees constant. In the theory video I have explained there are two techniques of calculating PBP. One technique when annual cash inflows are constant. Second, when it is uneven. Here it is constant. So simply apply the formula PBP is equal to initial investment divided by constant annual cash inflow. While watching the video, I always suggest my students to keep a notebook, calculator, pen ready and make the running notes. Whatever I am telling, the formulas and different important points, note it down. Otherwise, simply if you watch the video, you cannot get 100% from my lectures. Now see here, calculation of PBP. Since the annual cash inflows are constant, so PBP is calculated by the following formula. Simple formula is there. Initial investment divided by constant annual cash inflow. Initial investment 2,50,000. Every year constant annual cash inflow 40,000. So 2,50,000 divided by 40,000 you get 6.25 years. What is the 6.25 years? Whatever investment we are making, that will be returned back in 6.25 years. The time period required to get back our initial investment, that is called PBP. Now the project should not be accepted as the PBP of the project 6.25 is greater than the standard PBP given by the management, that is 4 years. तो मैनेजमेंट कह रहा है कि 4 साल के अंदर रिकवर हो जाना, but here the project is taking 6.25 years, more time. So this project is not acceptable. That is the conclusion. That's it. Now, second problem. A project costing 20 lakh yield annually a profit of 3 lakh after depreciation at 15% straight line method, but before tax 40%. This profit of 3 lakh rupees is given after deducting depreciation, but before deducting tax, right? But we need cash flow after tax. We need cash flow after tax. So we deduct the tax, calculate the payback period of the project. Remember one point. For calculating the PBP, we need cash inflows. In this problem, cash inflow is not given. It is saying accounting profit after depreciation, but before tax. Depreciation already deducted, but tax we have not yet deducted. That is profit before tax. Is how much given? 3 lakh. We have to calculate cash inflow. So from PBT, profit before tax, we deduct the tax. We'll get profit after tax. After getting profit after tax, we add back depreciation because we don't want accounting profit. We want cash flow. So for converting profit into cash flow, we have to add back the non-cash expenditure. The non-cash expense is depreciation. So first we have to deduct depreciation to calculate PBT, profit before tax, then deduct the tax, we'll get profit after tax. To profit after tax, we add back the depreciation, what we have deducted earlier. Now, initial investment 20 lakh. Now, annual depreciation as per straight line method is 15% given in the problem. 15% on the cost of the investment. Investment is 20 lakh. 15% of 20 lakh comes to 3 lakh is the annual depreciation. Now, profit before tax is given 3 lakh. From that, tax rate is 40% given in the problem. So, deduct 40% of 3 lakh, 120, 1,20,000. Deduct 1,20,000, you will get 1,80,000. That is the profit after tax. To profit after tax, we have to add back depreciation because we need cash flow. We don't require profit. So how to convert the profit into cash flow? Add back depreciation. Very simple rule. So depreciation 3 lakh rupees. Add back 3 lakh. 4,80,000 is the constant annual cash inflow. So every year cash inflow is same. So again we apply the same formula. PBP is equal to initial investment divided by constant annual cash inflow. The difference is previous problem constant annual cash flow was given in the problem. Here it is not given, so we have computed cash inflow. So remember the procedure, how to compute. Then initial investment 20 lakh, annual constant annual cash inflow 4,80,000. You will get 4.17 years. That means in 4.17 years, we can be able to get back our initial investment of 20 lakh rupees. That's it. Next, problem number 3. X Limited invested 1 lakh rupees in some project. The project generates profit before depreciation and tax annually for a period of 5 years. So every year 35,000 rupees is the profit before depreciation and tax. The scrap value of the project at the end of 5 years is 0. Determine the average rate of return of the project assuming 50% tax rate and straight line method of providing depreciation. First two problems we have done on PBP. Now this third problem is on ARR, accounting rate of return. What is the rate of return we are getting from investment in this project? At what percentage return we are getting? So there is a formula for ARR. ARR is equal to average profit divided by average investment into 100. So we need average profit and we need average investment. In this problem, I am going to explain you how to compute average profit and average investment. Here profit is given before depreciation and tax, but we need profit after depreciation and after tax. So first of all, ARR, average profit by average investment into 100. Annual depreciation as per straight line method is cost minus scrap divided by life. Percentage is not given. Previous problem percentage was given, that's why we have calculated 50%, 15%. But here percentage is not given but asking to calculate depreciation as per SLM. So cost 1 lakh, scrap value 0. Problem it is given. Then life is 5 years. So annual depreciation is 20,000. Now we calculate profit before depreciation and tax given in the problem 35,000. So every year constant, every year we are getting 35,000 before debt. So we deduct the debt minus annual depreciation 20,000 just now we have calculated. Deduct, we'll get profit before tax. So 35 minus 20, 15,000 is the profit before tax. Deduct tax. The tax rate is given 50%. In the problem given 50%. Less tax 50%, 7,500. 50% of 15,000, 7,500. Deduct 7,500. So remaining 7,500 is annual constant profit. It is not cash flow. Remember one point, in calculating PBP, we need cash flow. Whereas in calculating ARR, we don't require cash flow, we need accounting profit. And what is accounting profit? Profit after tax. That's it. So constant. Since annual profit is constant, so average profit is also same 7,500. Average profit will differ only when annual profits are uneven, different. If annual profit is same, even if you calculate average profit, you will get the same profit. So here 7,500 is the average profit. Now average investment. The formula of calculating average investment is cost minus scrap divided by 2. Then after making this cost minus scrap by 2, then you have to add back the scrap and add back working capital if it is given. But in our problem, we don't have scrap, we don't have working capital, so simply cost divided by 2. The cost of the project is 1 lakh. So 1 lakh divided by 2, 50,000. That is called average investment. So how much average profit? 7,500. Average investment 50,000. So 7,500 by 50,000 into 100. 15% is the ARR. So this is the first problem on calculating ARR. Each and every point I have explained clearly. Now fourth problem. A project will cost 40,000. Its stream of income before depreciation and tax during the first year through 5 years is expected to be 10,000, 12,000, 14,000, 16,000, 12,000. So initial investment 40,000. But every year the profit is not same. Uneven profit. Now assume a 50% rate of depreciation on straight line basis. Compute the accounting rate of return of the project keeping in view the cutoff rate at 13%. Cutoff rate of 13%. So here there is a mistake there. Assume depreciation on straight line. You cut off that 50% rate of depreciation. Cut off, it is by mistake it is typed here. Assume depreciation on straight line basis, not 50%. That is a printing mistake in the problem. So only assume depreciation on straight line basis, compute the accounting rate of return of the project keeping in view the cutoff rate of 13%, give your choice. Cutoff rate is the standard rate of return given by the management. The management says our cost of capital is 13%. We will not accept any project whose return is below 13%. We want a return above 30%, 13%. That is the contention of the management. Now, first of all, annual profits are different. So we have to calculate the average profit like this. So year 1, 2, 3, 4, 5. Every year, how much is the profit before depreciation and tax? PBDT. Profit before depreciation and tax. 10,000 first year, second year 12,000, third year 14, fourth year 16, fifth year 12,000. Now depreciation. It is saying straight line method. Cost minus scrap by life. The cost of the machine is 40,000. Project is 40,000. There is no scrap value at the end of 5 years. And the life of the project is 5 years. So 40,000 divided by 5, you will get 8,000. This 8,000 is the annual depreciation. Every year it will remain same. So 8,000 every year. So PBDT minus debt is equal to PBT, profit before tax. 10,000 minus 8,000, 2,000. 12 minus 8, 4,000. 14 minus 8, 6,000. 16 minus 8, 8,000. 12 minus 8, 4,000. So we got profit before tax. We have deducted depreciation. We got profit before tax. Now tax is at the rate of 50%. It is given in the problem. The tax rate is 50%. Assume a 50% tax rate. That printing mistake is there. Assume a 50% tax rate and depreciation on straight line basis. So 50% of 2,000, 1,000. 50% of 4,000 is 2,000. 50% of 6,000, 3,000. Like that 50% of all this PBT, we got tax. PBT minus tax, you will get PAT. So 2,000 minus 1,000 is 1,000. 4,000 minus 2,000, 2,000. 6,000 minus 3,000, 3,000. We got PAT, profit after tax. Take the total of profit after tax, we'll get 12,000. This is the total 12,000 profit in 5 years. But we need average. We need average. So average profit is equal to total profit divided by 5 years. So 12,000 divided by 5, you will get 2,400. This is the average profit. Now we need average investment. We don't have any scrap value. We don't have any working capital. So simply cost initial investment divided by 2. That means 40,000 divided by 2. That comes to 20,000 is the average investment. Now substitute in the formula. ARR is equal to average profit. How much average profit? 2,400. So 2,400 average profit, average investment 20,000 into 100. You will get 12%. If ARR is calculated on total investment, then ARR will be. Some authors says the ARR should be calculated on total investment, and most of the authors says it should be calculated on the average investment. So denominator, if we calculate on average investment, in the denominator take average investment. If we want to calculate the rate of return on total investment, the denominator you take total investment. The total investment is 40,000. So 2,400 by 40,200, 6%. On total investment, 6%. On average investment, 12%. Now finally, we have to give the conclusion. It is asking you to give the conclusion. How? Cut-off rate is 13%. Whereas our actual return is coming to 12% or 6%. So in other words, the cut-off rate is more. Actual ARR is less. Reject the project. The project is acceptable only if the actual ARR is more than the cutoff. Is more than the cutoff rate. Cutoff rate 13%. So the cutoff rate is 13%. The project should not be selected as the actual ARR of the project is less than the cutoff rate. That's it. So 2 problems I have completed on PBP and 2 problems I have explained on ARR. Now 5th problem. 5th problem is on NPV, net present value. A project costs rupees 2,500 and is expected to generate cash inflows of 900, 800, 700, 600, 500 respectively for 5 years. The project life is 5 years and every year cash inflows are given and initial investment is also given. The opportunity cost of capital may be assumed to be 10%. This is the discount discounting rate. The future cash inflows should be discounted at 10% and calculate the NPV for the given project. Now carefully you see. NPV, net present value. The formula is present value of cash inflows minus present value of cash outflow. The present value of cash outflow is given in the problem, 2,500. That is initial investment. We need present value of cash inflows. We are going to get different amounts every year. First year end 900, second year end 800, third year end 700, fourth year end 600, fifth year 500. We cannot add up all because the value of money will change from time to time. Time value of money already I have explained in the previous videos. So we have to convert the future values into present value. How to convert? You have to make this table. Year 1, 2, 3, 4, 5. Cash inflows are given in the problem. First year 9,000, second year 8,000, 7,000, 6,000, 5,000. Now we need present value factors. For calculating present value factors, you can apply the formula also, or else you can see the table, present value tables. In any textbook, you will get this present value table. And also in the link under my description, I am posting this present values. You can take a printout. In examination, present values may be given in the question itself. Or if it is not given, you can carry the present value in examination hall also. It is allowed. So always keep ready the present values. I have given in the link. Take a printout of this present value. So here, present value. Here, the first page of present value is here. The present value of 1 rupee. On the top, you can see the present value of 1 rupee, 10%. Last column, you can see 10%. First year, 0.909. Second year, 0.826. Third year, 0.751. 0.683. 0.621. These are the 5 years present value factors. So here I am taking 10%, 0.909, 0.826, 751, 683, 621. Now multiply the cash inflow with PV factor. 900 into 0.909, 818.1. Similarly, 800 into 0.826, 660.8. 700 into 0.751, 525.7. Like this, cash inflow will be multiplied with PV factors. We'll get present value of cash inflow. Last column, present value of cash inflow. Take the total of this present value, 2,724.9. This is the total present value of all cash inflows of 5 years. Now we apply the formula for NPV. The formula is present value of cash inflow minus present value of cash outflow. The present value of cash inflow 2724.9 minus present value of cash outflow, which is given in the problem, 2500. Subtract 224.90. That is the net present value. Now how to take the decision? What is the decision criteria? If positive NPV, accept. If negative NPV, reject. Here positive NPV we are having. So project may be acceptable. That's it. Now one more problem I am going to explain in this video, that is problem number 6. Again we have an NPV problem just like the previous problem. An investment is expected to produce the following. CFAT stands for cash flow after tax. तो CFAT कहिए या कैश इनफ्लो कहिए, एक ही मीनिंग है. Don't get confused. तो CFAT means cash inflows over a period of 5 years with an initial investment of 10,000. PV of cash outflow is 10,000. Discounting rate, cost of capital is 9%. Previous problem we have taken 10%. Now we have to take 9%. So this 9% present values for 1 year to 5 year. You can calculate on the calculator also, or else you can refer the table. So year 1, 2, 3, 4, 5, the cash inflows CFAT are 5,000, 6,000, 4,000, 3,000, 6,000. Required Using NPV, calculate the viability of the project. Whether project can be accepted or not. That's what we have to conclude. First we calculate NPV. Same procedure what we have done in the previous problem, fifth problem. Year CF80, cash flow after tax. And then PV factors at 9%. So if you again refer the table, PV table, so 9%, 0.917, 0.842, 0.772, 0.708, 0.650. These are the 9% PV factors. Multiply the cash inflow with PV factor. 5,000 into 0.917, 4585. 6,000 into 0.842, 5052. Like this you multiply all and then add up. PV of cash inflow total 18,749. This is the total of PV, present value of cash inflows. Formula: PV of cash inflow minus PV of cash outflow. PV of cash outflow is given in the problem 10,000. So PV of cash inflow 18,749 minus PV of cash outflow 10,000. 8,749. This is the net present value, NPV. That's all. So this is the first video on problems on capital budgeting. In this problem, totally 6 problems I have explained. First 2 problems on PBP, next 2 problems on ARR, and next 2 problems on NPV. Still many more complicated problems we have to do, and that we will take inshallah in the next video. So if you are satisfied, give a like to the video. Share my channel among your friends. Subscribe if you have not yet subscribed. Inshallah, we'll continue the next problem in the next video.